Check, check.
Purina One. We switched and wow, I know it's proven natural nutrition is helping support Charlie's strong immune system and Ginger's healthy heart.
See differences today and for a lifetime. Purina One, a difference from day one.
This is why I switched to Shopify. I tried 3 other platforms prior to Shopify, and I remember my breaking point was when I would try to make one little change and my entire site would go down. What are you waiting for? Start your free trial with Shopify today.
No, I'll just walk out some. I'm gonna go get water. That's what.
All right, good morning, everybody. If you could please take your seats. Just here. Yeah, thanks. All right, welcome everybody to the September chapter meeting. If you could please take your seats, it'd be appreciated. The panel today will, of course, be discussing the state of capital markets. This is a very important subject. It's on everyone's mind in our industry. And with that, we've got a sold out show. This is I'd first like to thank our gavel sponsors. You can see them identified on your table. Thank you so much for your support. Without your support, we wouldn't be able to have these chapter meetings. So we haven't been together since June, and a lot's transpired over the summer. Since our last chapter meeting, we held our CRE immersion program with Robert Morris University. The DLs had another outstanding golf outing, and they also had a bus tour featuring developments in Westmoreland County. So much appreciation to everyone who participated and supported those events. Now that we're entering the fall season, our event schedule only accelerates. So a couple of key dates to pay attention to as we progress through Q3. On October 5th, the DLs are hosting a project tour at Diamond Ridge. This is a tremendous new development by Scalo, visible from the Parkway in Moon Township. And then on November 9th, this is our 23rd annual Night at the Fights. It's one of our most popular events. Registration is now open, so please secure your spot sooner than later. And that's it for chapter business. I wanted to give ample time for this panel. It's a very important subject. So at this time, I'm going to introduce today's moderator, Bryan Walker. And while I do so, if the panelists could please come up and take their seats on stage. So in case you haven't been paying attention, Bryan Walker has been a key contributor to our region's success over the past 30 years. He started his career as a CPA before embarking on a nearly 20-year run with Millcraft, who recently rebranded as Pyatt Companies. There, he served as CFO and was part of the Pyatt family's leadership team that revitalized downtown Pittsburgh through a series of transformational projects. These projects brought housing, retail, office, and recreational spaces to the city at a time when we needed it most. And then just this past spring, in a splash announcement, Bryan became president of Scalo Real Estate. He's one of the most growth-oriented people we have in Pittsburgh, and it makes perfect sense for him to be leading one of our largest firms' efforts in expansion into new markets and new products. And as for NAIOP, Bryan has volunteered much of his life to our organization. He's a past president of NAIOP Pittsburgh, treasurer of the NAIOP Corporate Executive Committee, and beginning in January, he'll serve as national chair, which is a great honor for Bryan, and his visibility and his presence will help shine a light on our region, and we thank him for that. Welcome, Bryan. The floor is yours.
Morning, NAIOP Pittsburgh. So before we get to today's great event that we have laid out, I know everyone is excited to hear about all the great things in the capital market that we have going on here today. I wanted to just take a moment to say thank you, because I've been working with this board for a long time now, and to have an opportunity to give back to an organization as chair next year is truly an honor. And I can't wait to go around to talk about all the great things that we've done here in Pittsburgh, learn what other regions are doing and bring it back to Pittsburgh because for 18 years now, I could say without a doubt, this organization has been the sole reason why I've had access to knowledge, research, education, and networking, and it helped my career. So to give back to an organization that's done that for me is something I'm truly honored, and just want to say thank you to you because as your national board rep, you put me there. So we'll start there. Well, I had an opportunity with the mic. So today we have three great panelists, and I'm going to ask them to go down and introduce themselves, and then work down with Bryan all the way down to Tony. And when Tony, you get done, kick it back to me, and we'll jump into all the great news and learn how to survive to 2025, right? And remember, they did say survive the 95 before, and we went on a 30-year run in real estate. So let's not forget that too. So Bryan, why don't you kick us off?
Yeah. Thanks, Bryan.
Hey, good morning, everyone. Bryan McCann. I'm a senior vice president with Colliers. I help oversee the capital markets there. I primarily concentrate on acquisition and dispositions, and I'd say 70% of our time is on multifamily, with about 30% of our time in kind of the other food groups there.
Hi, I'm Claudia Steeb. I'm Senior Managing Director at JLL, formerly HFF. I've been doing this for a really long time. I focus on debt and investment sales and equity raises, primarily for retail and self-storage, but also participate in other product types other than hotels, because I have an expert in hotels in my office that's way smarter than I am on those, other than I stay in them great.
Good morning. Tony Rossi with CBRE. I'm a senior vice president in our capital markets group. My practice is focused predominantly on the debt and equity side of the business, with a focus on multifamily, and we handle other asset classes as well. But the majority of my practice is focused on the multifamily business. I've been with the firm for 12 years. Bryan?
Yes, sir. So let's get into it. Now, I think all three of you can probably comment on this question. First question for the day, Claudia, we'll start with you, okay?
Sure.
From a transactional perspective, properly underwritten assets can get financed today. How has underwriting changed over the past year? What are you currently seeing as it pertains to deal structuring, loan sizing, equity, and liquidity requirements?
I see we eased in.
I'm going right through it. Everyone knows my nature.
Okay. Yeah. And you're right. Deals can get done today. Everybody says there's limited liquidity, there's no money in the market, et cetera. There is money available. It's just a matter of what price. And when I've been spending a lot of time in retail, as I mentioned, and retail has not been a favorite asset class for years. It is now, which is great. But understanding the property and how it's going to survive. And when you talk about underwriting, you have to look at how stable the income is from a debt perspective. You can't look at hopes and promises for the future. So when you look at making sure there's enough money, making sure where your tenants are going to be coming from, what they're going to be paying in the future, what the risks are associated with losing tenants, that's what the lenders are all looking for today. They want to make sure if you're going to lose a tenant, there's some capital set aside. So you can't say, well, I put this tenant in, but I don't have any money. So as a result, you've got to look at debt yields, loan to values, and loan to values are a lot lower than they were. And that's a lot of what we're facing today is some of these properties had 10-year loans on, and 10 years ago, you could do a 75 or 80% loan to value loan. Today, you can do it, but it's a lot of structure and it's going to take every penny out of your property and you'll have no return for your investors. So when you look at all the metrics, the debt yields, the debt service coverage ratio, now that rates are up, you look at your income, the stability of the income, the sales in a retail property, your trends in history since COVID, even though COVID was 2020 rather, people still want to see how this property has performed since COVID. So that's a lot of what you need to do in order to be successful in getting a loan, securing a loan for your clients for property.
How about you, Bryan, on the capital disposition side?
Yeah, I mean, we're seeing the same thing on multi, especially. I mean, all loans are DSCR constrained right now. The days of underwriting, and we saw it less in this market. And I know we'll talk a little bit about how Pittsburgh is faring on the national scale. But underwriting 12% rent growth for 3 years to make a loan work is those days are gone. I think it's even now getting into 5% for, 3 years out. Some lenders are taking a really hard look at it. So the property needs to speak on its own. And you're in a negative leverage situation in a lot of cases. So we're seeing returns have to increase across the board, to make sure that the debt is working and that investors can get the return, as Claudia was saying. So I think that's kind of, programmatic throughout the market and all the assets that we're seeing.
Thank you, Tony. On the structured finance side, I know it's been tight. We've talked a little bit. Why don't you share some stories with us on that?
Sure. So, I agree with everything that Bryan and Claudia said. In the acquisition world in particular, which is a lot of what I've been underwriting these days, transaction volume is down substantially. And so to see these deals work at the cap rates where deals are still trading, we're focused really on, value add opportunities. And for new construction deals, I think there's a lot of people looking at non-traditional capital sources where they otherwise may not have looked in the past. Right. So it's a lower leverage A note with some form of structured financing, whether it's C-PACE is one of the new ones a lot of people are talking about. We closed a big C-PACE loan earlier this year to help a client get a large construction loan done. And soft money sources like locally, like programs like the RCAP and multimodal and things like that, where we're seeing soft money come in and fill the gap so that the equity tranches can still earn the returns that investors expect. So, definitely a changing environment. And I think people are getting creative. And like Claudia said, there's still plenty of liquidity in the market for good projects with good sponsors. It just is, you got to look a little further and wider and be creative when you're sourcing capital for deals.
On the deal structuring, guys, we were talking the other day that still deals can get done, but are borrowers making some mistakes in their underwriting that you're seeing? And is there a disconnect between what lenders are wanting to see and what the borrowers are hoping to see? Anybody want to touch that one with a long stick?
I'll try. I think one of the things that I've seen this year, more so than I have in the last 15 years, is, a lot of times when we were underwriting deals, people were hyper focused on the present. What's the debt service coverage ratio on this deal look like now? I think because we've seen such a rapid increase in interest rates over the last 24 months, lenders are becoming more focused on, excuse me, what's my debt service, particularly on construction, what's my debt service coverage ratio upon stabilization? And are these assumptions that we're underwriting realistic? Right. Because as Bryan pointed out, we've just, come out of a period of tremendous rent growth on a lot of asset types. And so I think lenders and borrowers, for that matter, are taking a lot harder look at their assumptions and studying the market to make sure that the rents that they're underwriting are achievable, and also that the operating expenses that they're underwriting are achievable. Because as everybody knows, costs have continued to rise in the inflationary environment that we're on, both from an operating expense perspective and certainly from a construction cost perspective. So I think assumptions are getting vetted really, really tightly right now. And that's, not to say it wasn't happening before, but I think there's more of a concentration on it than ever.
I think the other thing that really ties with that, and you led into it, is looking forward. You may have a lot of tenants in your building and their rents may be at or above market. And can that be sustained? And that's one thing a lot of the lenders are looking at. Of course, from a borrower's perspective, of course they can be sustained. The tenants here are paying me rent. Well, that's their story to the lender. But in all reality, they are looking back now and saying, can this tenant stay here and pay this rent? Especially on a retail side, what are their sales and is it supportable? And that's the one thing a lot of the lenders are looking at. Or what if you lose, if you have an AMC theater, what if you lose that theater? Can you still cover your debt service? And that's a lot of the analysis that the lenders go through, which, initially the borrowers or the owners hate, but in all reality, it is a good exercise to go through so they can realize, hey, do I need cash? And, when you're talking to your partners, if you got equity investors, I really need to keep this cash rather than distribute it to you, which no equity investor wants to hear, but it's easier than a cash call in 3 years when AMC says, no, we're leaving.
Claudia, is that something that people are referring to as the post-pandemic rent roll, seeing what tenants are actually signed up after the pandemic and really watching the ones that have maturities that will, kind of maybe burn off?
Yeah, the advantage that retail has is, pre-pandemic, there were a lot of tenants teetering on bankruptcy. The pandemic cleared those out. I mean, that's sad to say, but a lot of retail tenants and a lot of tenants don't exist today that existed in 2015 per se. So the post-pandemic rent roll is exactly that. Who's left? And most of the tenants that are left, the bankruptcy watch list is very small right now. There's only a handful of tenants that are really on the bankruptcy watch list, and that's because they've been cleaned out. But looking at what their rents are and if they're sustainable, fortunately, for the first time in a long time, overall across the nation, there is an increase in retail rents overall. Now, we've seen some of that here. It's been seen in a lot of the major, popular cities, et cetera, but there's been no new retail construction for the past 3 years at a minimum, if not even before that. And that had nothing to do with construction costs at that time. Now it's rolling into construction costs as well. So occupancies are going up to 90-95% across the board. And it's now becoming a little bit more of a landlord's market in the rent, but it still has to be a sustainable rent.
Yeah, I'd say the two areas that we're seeing at the most of the disconnect, one is rent. And, Claudia mentioned the high rents. We also see the other thing is if you have a new construction that delivered a year ago, where you were giving concessions to fill up a building, whether it be office, industrial, multifamily, it's now saying, okay, those, we've got our building filled now. We should be able to mark this to market. Not even talking about aggressive rent growth, but just bringing up the market. You might be 15% off under market. We have a deal now where we've been going back and forth with the lender, trying to explain concession burn-offs, like, where parking is easily like $200 below market because they were giving away free parking and just getting beat up on that side on saying, this will all get marked to market because now the building is filled. Of course, they gave them away free early. So I think that's a huge thing. And the other big side is insurance. Luckily in Pittsburgh, we're not getting beat up with insurance as much as some other areas in the nation. If we look at multifamily, $400-450 a unit is still kind of in the range. In Florida, you're seeing things at $1,700-1,800 a unit for insurance costs that are just going through the roof. So the lenders are taking a really hard look at that. If you're in a floodplain, if you're in one of the coastal markets, the insurance market and what your insurance today and what it'll be in the future, that's getting really scrutinized right now.
Thanks, Bryan. Stay with you, okay? You and I were talking about this over a cup of coffee recently. Thought we'd bring it out here for the group here today. We are trying to operate in a world today with the most conflicting data points in history right now. Can you talk a little bit about that and what are some of the key indicators that you might be tracking?
Yeah, I mean, look no further than, the Fed's comments yesterday, right? I mean, employment is still strong. I think we're at 3.8. So we did see a tick up in the unemployment numbers, but job growth is still strong. Wages are rising, and yet we're in an inflationary environment. And those are just kind of conflicting right now. So everybody is uncertain, and uncertainty is almost worse. I always joke around. I was like, if you're driving on a pothole road and you can see the pothole, you're okay. You know how to swerve to avoid it. But if you're driving in the fog and you don't know what's going to happen, that gets really worrisome because you might be fine, you might not be fine. And that gets a lot of angst. So everybody kind of freezes up. And that's kind of what we're in, is because we're in this environment where, everybody claims to know what's going to happen in the future, but because there's conflicting data points, we're not necessarily sure which way it's going to tip. So I think that causes a lot of seizure and a lot of analysis and a lot of paralysis by analysis at the same time too. So as we're seeing that kind of conflicting data, I think everybody's wondering is which way is this going to go? Are we going to stay on a strong inflationary trend, or is inflation really going to drop off and we're going to have the real soft landing that everybody hopes for? We were at a meeting last night and somebody joked that they said the Fed is doing a great job creating a soft landing for everything that they have no control of, like jobs. So I was like, it's kind of a funny statement, at least from the real estate side, because obviously the interest rates and, it looks like we might be in for another hike and then less cuts next year than we were seeing.
Now, Claudia, you told me if you could predict the future, you wouldn't be sitting on this stage. Are you seeing anything different on your front on the retail side or the self-storage side that tracking trends?
Well, trends in retail have been really positive this year, which is very unusual. I think I had said to Bryan earlier, beginning of this year, I actually had lenders calling me saying, hey, do you have any retail deals I can finance? Which at that point I was like, hello, are you sure? Because retail had been a 4-letter word, and I know there's more than 4 letters in it, but for a long time, it was the bottom of the barrel. Nobody wanted to touch it. But coming out of COVID and everything, and as I mentioned before, the lack of new construction, occupancies are heading up. And as long as you have the right sponsor, which I think you had mentioned sponsor earlier, with the right sponsor, people will finance retail. And then talking to lenders, hey, what are your plans for next year? Retail, it's not as favored as multifamily or industrial. Those two still remain the two darlings, although I think, I'm not sure which one's above the other at this point in time, but retail's edging up there as, hey, you know, well underwritten, strong sponsor retail is, we'll take a look at it, and we're not going to charge you 500 basis points over. We're only going to charge you 250 basis points over, which is getting close to the rates for industrial and multifamily today. And I think, you know, when is the yield curve going to become uninverted? I think is a great question. I don't have the answer to that. If I had that answer, I wouldn't be here either. But you know, 5-year money is more expensive than 10-year money, which is really hard to grasp because the longer your term, the higher your rate should be. But it hasn't been that way basically this whole year plus. The 10-year treasury started at 3.5 this year. It's now almost 4.5. That's 100 basis points in just this year that we've seen. But at the same time, the 5-year treasury has been above the 10-year treasury this entire year. So when you have that happening, it's hard to say, what do I borrow? And everybody's been wanting to borrow short term because think rates are going to come down. That's been the consensus for many years now. Oh, rates are going to come down. I'm just going to borrow short term. I'll be able to borrow more later. My comment to every client is, if the deal makes sense, you take it. If I had that crystal ball and could say, yeah, rates are coming down, that's great. If you look at all the forward projecting yield curves, et cetera, I had a client that looked at one a year ago, last summer, and he's like, you know what, I'm going to wait because they're showing the yield curves coming down in 2024, end of 2023, so we should be okay. And I met with them multiple times. But again, this year, he's like, I'm looking at these teal yield curves. What happened? Why aren't these rates coming down? The Fed said they were going to come down, you know, and it's like, yeah, we can't predict that. They look at all the algorithms and everything along the way to try to figure that out. So I think going forward, conservatively, well underwritten deals with strong sponsorship have a way to be bought, sold, financed, et cetera. And that's really what it takes.
Tony, I'm going to be coming back to you to start this next question, but I don't know if you have anything else you want to add on that last one.
Yeah, I'll chime in quickly. I think, Brian, you started the question asking about conflicting data. Generally speaking, I don't put a ton of weight in national data whenever I'm looking at deals locally in Pittsburgh, because I think national data gets skewed pretty heavily by gateway markets and dynamics that are taking place in other markets that operate very differently than Pittsburgh. However, I did think it would be relevant to look at some national data today. So I just pulled a few points real quickly with respect to transaction volume and things like that. So U.S. commercial real estate investment across all asset classes is down 50% in the last 12 months, trailing 12 months. Multifamily was the largest segment over that 12-month period, traded $182 billion worth of inventory, which is a 55% decline from the previous 12 months. Real Capital Analytics, which is a very reputable and trusted source of information in our business, says that the property price index for properties in the United States is down 10% over the last 12 months, which basically means the aggregate value of all real estate assets in this country has declined by 10% in 12 months. You know, and I'm not going to go into all the statistics on a lender by lender basis, but, you know, as a result of that, loan origination is obviously down because there's been a lot less transactions. And so, you know, that begs the question of what's really going on out there. And is it dysfunction within the assets themselves, or is it a greater market phenomena that's happening? And I think one of the biggest things that's happening with respect to trades is you have a failure to have a meeting of the minds between buyers and sellers, right? There's just cap rates are creeping up. The cost of capital is going up. And as a result, you have owners who are reticent to sell because they're not meeting pricing expectations when they're running a market process. So with respect to data, I think, you know, those are some data points that kind of jump off the page at me. And so, you know, in order to remedy that, you're going to have people who either need to have a capital event because of fund duration or investor expectations, or they're going to get forced to have a capital event based on some other trigger in the capital stack, like a loan coming due. So, you know, I think we will see asset trade volume come back up, you know, by hook or by crook, right? It's either It's either going to happen organically because people have come to a realization that assets are worth less than they previously were, or they're going to get forced into doing it by their lender.
If I can just add
Oh, please,
quickly
Claudia.
to that. No, I wholeheartedly agree with what you said. And we did a study, right before ICSE, in May, of clients. It was a blind study that went out and to, see what people's thoughts were. And we went to owners of real estate and said, okay, if you wanted to sell a grocery anchored retail center, what would your expectations be on a cap rate? And they said 5 to 6%. Great. If you were to buy a grocery anchored shopping center, what cap rate would you pay? 6 to 7%. There's your bid ask gap. I mean, and that came truly from people that are active in the market. So that's exactly what you're saying is people still think their properties are valued more when they're selling them, but when they're buying them, they don't want to pay that same cap rate.
I'm gonna shift my whole agenda around because you just you hit a.
Did I blow your mind, Brian?
No. I'm just gonna adjust on the fly. It's my nature. But actually, Claudia, you mentioned the bid ask gap. So I'm going to stay there a little bit because I was going to talk a little bit about that. So Bryan, you also talked about that as well, as there's this delta, and how are deals getting done in Pittsburgh with this bid ask gap. So let's kind of shift focus to that topic, and Tony, then we'll bounce back to you.
Yeah, who did you want starting, Brian?
Go ahead, Bryan.
No, I'm in. So yeah, I mean, there is a huge bid ask gap, and the main reason why Tony mentioned it earlier, and it's everyone's looking for value add, and they're looking for value add so strongly, even core and core plus deals, they're pricing on value add metrics. So that's how deals are now getting done, is you got a core deal that just delivered and they're using value add metrics to evaluate that deal, saying, yes, we have capital for that, because there is liquidity in the market, but it's extremely choosy. And because the returns are necessary out there, you're seeing that increase. So what does that mean? What is happening is now we're seeing things trade for below replacement cost, which is really, really scary for a lot of people, especially the developers in the room, right? So you're seeing things trade that were below what it costs to build. So how do you handle that situation, especially if you've got a construction loan coming due? And as Tony mentioned, you're kind of forced to sell. So a lot of times the developers, they're out of their promote. They have no money to be made. So we're seeing creativity kind of creep in now, where you see the GP moving into an LP position with the next buyer, because they're saying, we believe in this asset. The asset's strong. It's just the market right now is affecting these returns. So we'll come along for the ride for long term. We'll come in and take an LP tranche and convert our equity into that and go along for the ride. And in 3 to 5 years, we'll weather the storm and kind of move that through. So I think you're seeing the creative deals, loan assumption deals is huge. If you have debt that was put on 18 months ago that has a long-term horizon, that's great. So we're seeing tons of assumptions. We're seeing some seller financing, even on institutional level, where that used to be confined on more kind of the private capital space. We're seeing it on institutional transactions where, the seller's like, hey, we'll carry some paper back on this in a position. So I think using those type of scenarios is how we're kind of bridging that gap right now in the short term. And everybody's still has bullish tendencies that this is a short-term problem. Now, short-term could be 6 months, 12 months, a year, or 2 years, because the survive to 25 is well and alive.
Tony, is your chair stable over there?
Yes.
Let's talk about the other 4-letter word. Office. I know this is Tony's favorite topic right now, but
we had a prep call for today's meeting, and I expressly warned everyone that they should not ask me any questions about the office market.
And I said, I'm retail.
Well, I'm office too, so I might have a few things to chip in on this here.
Sure.
So, but listen, I mean, it's an important topic. I'm sure a lot of people here are wondering about it. So we got to have a conversation about it. So why don't you kind of give us how you're feeling about that process right now, what you're seeing? I have a feeling there's going to be a good back and forth here all across the board as to what we're seeing locally in Pittsburgh, as well as the bifurcation of assets, the old and the new. Tony?
Sure. So with respect to office, I think the first thing that we need to say is when you're talking about office, it falls squarely into 2 buckets. The first one being CBD downtown office, the second one being suburban office. The dynamics that are at play there are very, very different. I think many downtowns like ours are working through a little bit of a post-pandemic hangover with respect to getting employees back into the office, maybe some dynamics at play with respect to different elements that have shifted in to those environments. A slow reopening of some of the Main Street level businesses that are operate in downtowns. It's a really challenging environment. And you'll find no bigger cheerleader for downtown Pittsburgh than me, by the way. I come downtown every single day. I want it to be great. I love it down here. I lived downtown for several years before the pandemic. I'm a huge fan. But I'm also a realist. And so there are challenges, not only like at the public policy level, but also on the asset ownership level, right? So, firms that office downtown and have downtown office space are shrinking. It's a fact. A lot of groups that are have leases rolling are either shrinking within their own footprint, or they're moving to different buildings and they're looking for a different type of space that's higher quality to draw employees back to the office, because that's important. It's important for a lot of people. I think there's also, there's other firms that have, grappled with or realized, hey, we're never getting back to everyone in the office 5 days a week. And so how do we adjust to fit our space needs accordingly, whether that's more hoteling space on less square footage, whether it's, folks that are working from home full time and the compensation package looks different. There are some challenges to come through the ringer. I know I talk to the office leasing folks at CBRE in our office all the time, and they're optimistic and they're saying volume now is better than it ever has been post-pandemic, right? Just, things are continuing to move in the right direction. So, I have a lot of optimism that things are going to start moving back in a positive direction, but there's a lot of pain out there right now. I'd also like to touch on one point that seems to be everyone's, a lot of people's focus is, well, we've got too much inventory, but that's okay because we're going to convert it all to multifamily apartments. Let me be very clear. No, we're not. Okay. A lot of these buildings are functionally obsolete. The floor plates don't line up for apartment buildings. And most importantly, the amount of money that you can charge for an apartment in downtown Pittsburgh does not support the cost to convert these buildings into apartments without a very large amount of subsidy, right? And so that's an important point, because there is a path to doing that, and it would be great, and it would be a great solution for this problem. But the stark reality is that right now, in order for this to make sense, we're going to need a public-private partnership of sorts to get money driven into this part of the region to supplement the cost to convert these buildings, because from a pure capitalistic economics perspective, it doesn't make sense. And now I'm going to stop there.
I'm going to bounce over to Claudia and Bryan too to comment, but this is your show, but I do want to make a comment on behalf of NAIOP. Yesterday, I met with Senator Kerry out of Columbus, and NAIOP will be introducing a bill to the House Ways and Means Committee that will present a bill or 20% tax credit for upper floor office conversions to an alternative source. It's going to look and feel a lot like historic tax credits, whereby you can sell that to bring in some capital essentially to help defray the cost. Because I do agree with Tony, they just don't make sense without alternative sources of capital. So just FYI, you'll be hearing more about that here soon. Claudia or Bryan?
Yeah, I mean, I'll try to go a little positive on office, is that it can be financed. It's just most people don't like where it can be financed. We had a major downtown office building on the market. I was in charge of finding debt for a buyer. I literally had 10 quotes from 10 different lending sources for that. Now, problem is it wasn't 75 to 80% of purchase price. The maximum you could get was 62.5% of purchase price. So that still requires a big equity check, but at where the property was going to trade from a cap rate basis versus where interest rates are today, you could still make that happen. So again, it goes back to Bryan, your earlier question, the question I guess you raised is, what's properly underwritten? Well, when you're buying at below cost, perhaps, replacement cost today, because otherwise the numbers don't work. and you have a plan, what are you going to do if your office is half full, or maybe your office is full, but where are the rents? You can't count on increasing them another 20% over the next 3 years, but you can finance it, and you can finance it here. And we finance deals in Houston. If you can do deals in Houston, I figured I can do a deal here. And that's exactly what that came down to. So again, it's not that 80% financing unless you want to put on mezz and pref equity and, public sources to the extent they exist, CPACE and everything else. Then again, you're not going to have any equity to return to your investors for a while, but it can be done. So that's as positive as I can get. Okay.
Yep. Bryan, prior to the pandemic, it was okay to be adept in deal making, to swoop in, buy property right, do a few little tweaks operationally, ride the compressed cap rates, and go make a ton of money. So as we're hearing this right now in the office, how are you feeling about that process, and is it different? And also comment on any follow up on the office side of things.
Yeah, I mean, I think with all assets, but especially with office in this environment, you're seeing one thing, and that's flight to quality, right? I mean, and that's always been the case, but we're accelerating that. And when we say flight to quality, I kind of mean three things: asset, area, and convenience. And I think those three things kind of have, like, the asset has to be a quality asset. The area has to be a good area. And by good area, and we talk a lot about downtown, the primary thing there is safety, right? You want to be safe, and like you want to be able to go where you're at and around. And then convenience. And this kind of goes into the fact of, yes, if we could convert buildings downtown, if it made sense, that's great, because now it's convenient. It's convenient for the workers. You can kind of have a, walking area to go to. But if you don't have those, right, there's a lot of options out there in the market for people to go to. So it's not just pick up the building at the best, at the cheapest price, and, we'll charge whatever rent makes sense, because you could have those buildings go empty very, very fast if you don't have those three things, because there's competition out there. And sometimes, and that competition right now is mostly being filled by the suburbs. And that's why we're seeing that, or the greater downtown. I think there is optimism, though, on there. You're seeing, and this is, again, look at national trends. People are coming back to the office. You're seeing it through mandate, or just for the time that we've been out of the office, right? We're losing that connection. We're losing that connection with the, individuals. A lot of business owners have said it's not necessarily the productivity and the efficiency, because people will get their job done and then they'll check out. It's the innovation that is starting to stifle, because it's those offhand comments that we have over a break or having coffee that's not related to just getting the task done. That is starting to fall. And we're going to see, and the problem with innovation, right, is it shows up about 5 to 10 years down the road. So we're not seeing the fact that that's where it's going to fall off. We're not being as creative and moving things forward as fast as we used to, because it's really hard to just schedule a coffee over a Zoom call and just chat about something and then come up with a great idea. So I think that's what we're seeing. I think the companies are starting to feel that on a nationwide. I mean, New York's starting to kind of press the forward button on that. And then a lot of the other markets are going to follow. And then, as Tony said, it's really tough to convert. I think studies are between 10 and 15% of buildings are actually convertible. I mean, there's buildings that have sat in downtown Pittsburgh that, they're big giant squares. Those are really hard without drilling an atrium down the middle for a light well, which can be done, but is very costly. It's really hard to convert those into anything but office space, and traditional office space, where you basically had offices around the side and a bunch of cubes that have no light in the middle, which is also an outdated practice. So when you see one of those functionality obsolescence, it's really hard to recover from.
All right, I'm going to move on, but I do reserve the right to come back to this topic. Let's shift into multifamily a little bit. Folks, what are we seeing about multifamily deals and structuring? And this is probably, a number of people that can comment on this. So I'll throw it out to you guys to see who wants to go first.
Sure. Like I said at the beginning, this is where I predominantly focus my practice, and I know Bryan does too. We've stayed extremely active this year in spite of the capital environment on the multifamily side of things. We're still doing acquisition deals. We're still closing construction loans. And we're still seeing really great value add opportunities. We're also seeing deals that are rolling off of construction loans that haven't quite seasoned or delivered as expected, because of whether it was a COVID delay or whether it was cost overruns that aren't ready for the permanent markets yet. So I'll start there. On those deals, there is plenty of liquidity in the market to bridge deals that are not quite ready for the permanent market into, whatever the next capital event is on the 12 to 36 to 60-month horizon. Whether it's the deal's ready to go and the seller doesn't want to sell because they don't like where cap rates are right now, or whether it's an asset that somebody decides they want to hold, but they want to get a couple more years of seasoning on it before they go to the agencies to put permanent debt on it. We've closed a number of shorter term bridge loans to move those assets from, post-construction into the permanent capital. So there's plenty of liquidity there. On the construction side of things, we've got a loan closing in a couple of weeks, ground up construction deal in a major Pittsburgh submarket, urban submarket. I would say that leverage is a touch lower than where it was, 24 to 36 months ago, but that's not indicative of anything other than where capital costs have gone, right? Properties service less debt when you're paying 6.5 on the rate. But there's, still plenty of liquidity for good projects and good sponsors. And then, on the value add side, both urban and suburban and really secondary and tertiary markets, we're seeing deals continue to get done where there's, whether it's a mismanagement story, whether it was a lack of capital story, whether it was something else, lenders are leaning in for good sponsors to put loans out on good properties. So I think the liquidity for the multifamily market remains very, very strong. I think in times of distress, multifamily always rises to the top. And one of the largest reasons for that is the capital provider for multifamily is a quasi-governmental, government-backed agency system, right? You've got Freddie Mac, you've got Fannie Mae, you've got the FHA. They've never gone away in times of distress. In fact, they've thrived in times of distress. So from a secondary market perspective, multifamily always has an abundance of capital available to it. And so as you work your way down the capital chain through various different capital providers, they know that if a deal is executed properly, there's always going to be a takeout.
I was just going to say, just to kind of add a little bit to that is, at the beginning of the year, we heard a lot of the life companies and the banks say, well, we've got a lot of multifamily in our portfolio. We might slow down on that, but that's not happened because multifamily still works in general. So, even though the initial reaction was our portfolios are a little heavily weighted towards multifamily, it's still, they're lending on it.
Yeah, I think post-COVID, right? The vernacular was beds and sheds, multifamily and industrial, as Claudia said earlier. So I think that's kind of where everything, because if you've got a nice apartment deal, if you really need to fill it up, you can just shop rates and there's people that will rent, as opposed to if you have an office, sometimes no matter, even if you chop the rates all the way down in the wrong area, there might not be a tenant for it. So I think that's the case. It's still before 9 o'clock, so I apologize for math this early. But I think what we're seeing is, 18 months ago or now 2 years ago, core assets, you're looking at 11% levered internal rate of return on a multifamily deal, right? And that's with the debt environment where you're at close to a 3.0, give or take. Now we've got debt that's, up in the sixes. And the problem also is we're now demanding a levered internal rate of return of 13 plus on those same core assets or even higher. So that's a combination that really kind of brings everything down. So what happens is, even though construction deals are getting done nationally and even locally, they're slowing. So what does that look like? If you can get a construction deal done right now, by the time you deliver, because everything else is slowing, you're going to be one of the few deals that are delivering. So if you can weather the storm, you're going to come out really great when you're about ready to deliver, because just the supply side is getting so low. And we are always supply slide constrained here in Pittsburgh. I mean, make note, we did not build nearly enough in the 90s and early 2000s. So people were like, see cranes in the air or new multi-filling buildings go up. We could build for 10 years. We will not fill the supply that is needed to cover the market. So the good news is if you can get deals done locally, especially now, you're not going to be competing with many products coming out there. What's going to be difficult, right, is those that are delivering in this crisis through the next, 2024, and we kind of see things there. But again, how are we getting it done? You're seeing things, alternate sources of financing that Tony mentioned, different types of equity coming in, and we're seeing, players kind of stay in longer, where a lot of people had a 3-year or merchant builder kind of build, stabilize, get out, or 3 or 5 year. They're willing to stay in longer now to kind of see those returns.
Let's stay with the multi-family topic, but I'm going to put a little twist on this a little bit. When we were talking, there was some dialogue exchange about companies coming in to, with high risk exposure, buying a deal, paying a lot of money for it, hoping to get rent growth. Cap rates were great, ride that cap rate, make a lot of money. Those days have changed a little bit, but we think there were some comments about Pittsburgh might be a little bit different. And why is Pittsburgh going to be able to weather that storm a little bit differently than other locations? So from a multifamily perspective, a retail perspective, Claudia, I know you had a few thoughts on that, and Tony, from an office or multi side, let's share some thoughts on that with our group here today.
Yeah, I guess on the multi side, a couple things that I think position Pittsburgh well on the national stage. One is, if you went down, 2 years ago in Florida, we saw 12% to 15% rent growth being underwritten for 2 to 3 years to make those deals work, because they were buying at a sub-3 cap in some cases. We were never in that severe of a market. We were trading in the low 4s, but we weren't trading those sub-3s. And even in those low 4s, we were maybe underwriting 7%, 8% rent growth, year 1 and 2, and then a more conservative 5 and 3 thereafter. So I think because of that, it's the old Pittsburgh story is we've never seen the crazy boom, but we never really see the crazy bust because we're a little bit more steady of a market. And that's still the case that we're seeing there. Couple that with Pittsburgh continues to gain exposure on the national stage. More equity and institutional equity is coming into Pittsburgh than ever before, although it's slowing in the last year. But even in the events, we were up in New York the last 2 days, and more groups who are a little bit smaller who said, hey, Pittsburgh's always being talked about now. We want to come to Pittsburgh. We want to invest in Pittsburgh. So I think you're still going to see capital coming to the market. And we're one of the markets that you can still get a good yield on. So because that capital coming in, because we don't have the crazy booms and busts, I think we're better positioned to come out of this. And if you look at rent growth right now, the top cities are actually Midwest cities, Indianapolis, Cincinnati. Those are some of your top rent growth cities, and Pittsburgh's not far behind that as well. They're seeing the largest rent growth now, just mostly because the Smile states have dropped off so severely.
A lot of what you said applies to retail as well. Retail, it's never been overbuilt in Pittsburgh because, I get a lot of calls from people that'll be looking at a property in Pittsburgh and they say, I know this isn't your deal, but the broker, Tony, is telling me I can't build next door. And I'm like, well, unless you have a place to put a ton of dirt, or unless you have a ton of dirt to fill, that's a hole and you can't build there. So our topography has really helped us in every asset class in Pittsburgh. We really haven't been able to overbuild. And as we bring investors and lenders to Pittsburgh, they see that and they're like, oh, you're right. This is hilly. Oh, you don't have a beltway. Because the one time I had a buyer come in to look at a property and he wanted to see the distance between South Hills Village and Century 3 Mall. I said, no problem. I can do that. And he said, but I want you to take me on this beltway. I'm like, what beltway? He's like, well, the orange belt. Oh, no problem. So we're driving between Century 3 Mall and South Hills Village on the orange belt. And he's like, where's the beltway? I said, right there. Look at your sign. So the fact that we don't have a beltway has helped us in that regard. Also, it's hurt us at times, but so when you look, we haven't overbuilt. I have conversations all the time with our national team. Why are you only putting a 6 cap rate on grocery anchored retail in Pittsburgh? Because that's the best we ever got. 5.25 is the best cap rate that has been achieved on grocery anchored retail in Pittsburgh, like since the 80s. I can't go back before that, but so as a result, we have not had those super low cap rates, which as a result, we've been able to get higher returns in our market. And that's what investors, when they see that, especially in a rising rate environment, our markets become a lot more popular to us outside investors that have, oh, there's no rent growth, there's no growth here, there's nothing. Well, all of a sudden, we're not busting as much as some of the Smile states are. So people want to be back here. And as I mentioned earlier, from the retail perspective, so little new building has taken place that everything's filling up. So again, it's becoming a little bit more of a landlord's market, where you can raise rates, where you had to hold your rates in, your rental rates flat or decrease a little. You're able to slightly increase them now.
With respect to supply and demand, right, was the question, Brian, generally.
Yep.
So, I'll touch back to office. That way I don't get a reputation, because I might have come off as slightly negative before. But I do want to say, I think the Pittsburgh story is still good, right? Pittsburgh, the fundamentals of Pittsburgh and sort of the parochial nature of what we have here with, we've got a lot of great universities, right? But, when you look at the companies that are spinning out of Pitt and CMU and the energy and inertia that's driving in our city, it's great. We've got really well endowed foundations and arts organizations and things of that nature that make our city great. Do we have a little bit of a supply and demand imbalance in the office market? Sure, of course we do, right? But so does every other city. And so I do, although I think that we're, going through a challenging period right now. I think that as the office market continues to progress down the road it's on, one of the biggest factors that's going to impact it is employment, right? We've had really, really strong employment since COVID. And so it's been an employees market, and employees have had a lot of power over employers. But, as we sort of progress down the mild recession that we might be heading into, I think that dynamic is going to flip, and employers are going to regain some leverage. And I think that we're going to start seeing more and more people back in town. I also think that because of the dislocation that's happening in the office market right now, it's going to create one of the greatest buying opportunities of a generation for office. And so I think that unfortunately we've got a little more pain to go, but I think that as we come out the other side of it, we're going to see opportunistic capital come in and reposition some of these assets, whether it's through conversion or a refresh. I am optimistic that, there's light at the end of the tunnel on the office market side. So I think it's a great opportunity for people to deploy capital and come up with new and innovative business strategies.
I know we want to go to Q&A, but I'm going to just ask for one more second, please, because you started to open up an area that I thought we might work our way down through. So I just want to stay on this topic about distressed assets. There's $205 billion sitting on the sidelines right now, ready to pounce for what they think is going to be distressed assets. I'm curious if you think that will work its way into the Pittsburgh region, or if Pittsburgh's weathering the storm a little bit differently than some of the other areas that our regional banks and our assets will be treated or looked at differently.
I love this topic. It's funny, right? I get calls. I've gotten 10 calls in the last 2 months. Hey, you need deals that are going bad? Hey, you know anything that I can buy? Hey, what's going on with this? Right? Everyone assumes that we're going to have the buy it for 10 cents on the dollar type phenomena that happened during the great financial crisis. We're not. Why? Because everybody's looking, right? And deals don't trade for 10 cents on the dollar when you have 10 guys trying to buy it for 80 cents on the dollar, right? So yeah, is there going to be some dislocation? Yeah. Are deals going to go bad? Of course they are. And that's whether it's because of mismanagement of the people who are running them in the first place, or, loss of a big tenant, an unfortunate situation. I mean, there's all kinds of reasons that deals can go bad. And so, yeah, we're going to see a little bit of distress. But Brian, to your point, and it's interesting. I was at a national capital markets conference this spring, and I don't remember the statistic off the top of my head, but suffice to say, it's like there's at least 6 times more capital chasing deals in the United States right now than there ever has been before. There is more capital chasing deals in the United States for a variety of reasons than there ever has been before. It has to do with foreign money flowing in. It has to deal with, private equity and private equity firms getting more involved in the ownership of real estate. And that's why you're not seeing cap rates blow out as fast as interest rates have, because there's just so much capital chasing deals.
Hey, Bryan, what's your thoughts on that topic?
Yeah, I'll just be real. There's a number of groups out there that are already backing up the truck. And they're like, if we're heavy cash buyers, we're already buying to discount. If you can buy stuff below replacement costs right now with no lease up risk, with no development risk, they're like, why not? Right. So I think Tony's point is right on. We're not going to see that drop. You might get a discount below replacement cost, but there's a floor to where we can go. And in Pittsburgh, I think even there's a floor nationally. And I think our floor is even higher than where it is nationally.
The other side of that is we're seeing more loan sale opportunities rather than have the distress sale of the building. Somebody can go in and buy the loan at a discount, but the building isn't a distress sale.
Do we want to go Q&A?
Two.
We could be here all morning. How about questions from the floor?
Oh, I meant here. Yeah. One or two questions in the floor.
Yeah. Let's get the mic over there if you wouldn't mind.
We're also on Zoom. So.
We've heard a lot about what percentage of the downtown buildings are logically able to be converted into residential. But having said that, as a contractor involved in a couple of those right now, we're seeing an awful lot of out of town people that have us walk around some of the buildings downtown that we would not have thought it would be prime candidates. Having said that, there's a lot of people knocking on our door that want to walk these buildings that are either very naive or they're wasting a lot of our time walking around these buildings. But it's a pleasant surprise for us that some of those buildings that we thought were marginal have more than one out of town firm looking at them. Are we on a fool's mission, or is that a real thing?
There are buildings that are able to be converted. I've underwritten several, and there are deals that work. It becomes a function of return expectation for that capital, and also some degree soft money, right? And so I don't want to say that it's a fool's errand because buildings will get converted. Buildings are getting converted, right? I mean, there's several buildings that are under conversion right now. I've got deals that I'm working on deals that are conversion deals. And so I do think it's feasible. I think the point that I was trying to make is that there's a sentiment out there that we're going to just snap our finger and convert a bunch of buildings into 5,000 new apartments. And that's not going to happen. I think it's much more complicated than that. And it's going to require a lot of hard work and creativity, and I think subsidy. So no, I don't think you're on a fool's errand. I think that there are deals that can get done. But the point that I was trying to make is that it's not as easy as everyone thinks it might be, or that some people think it might be.
Any other questions from the floor? Thanks, Steve.
No problem. With the possibility of the URA, City of Pittsburgh, putting together a TIF and LRTA package, 3-year plan, will that help move some of the properties in the Golden Triangle District?
Good question.
Just to stay on the same multifamily conversion point, absolutely. Those are the types of programs that we need. And I think that, any efforts the city can make to help generate available capital will also spur further investment from state and federal sources that could further help fund the conversion of some of those assets, whether it's a conversion to multifamily or a reposition of an office deal for the same use. There's a lot of soft money out there that can be available for these types of products. I think our NAIOP chapter has done a really good job helping trying to advocate to move some of those programs forward and create opportunities for our city. And so anything that anyone can do in this room can do to try to, help propel forward the availability of soft money for conversion or repositioning is extremely important to our region.
And just to kind of echo that, I think it obviously is helpful. What we have in place today is a drop in the ocean to what we actually need. I mean, Tony mentioned it. Conversions are almost sometimes more expensive than building new, right? And when you're looking at the same rents and you want to do it, you really need some aggressive public-private partnership and some of the programs to move on there. There's a lot of groups out there that now that won't even, the LRTA is such a drop in the bucket. They're like, we don't even want to go through the pain. It's not even worth it, right? To go through that process. So, but if we can bolster that up through TIFs, programs, some more soft money, then yes, it will help. But I think the advocacy behind that is essentially important.
I think the key is soft money. It really has to be soft money, which you guys both alluded to. If it's got too many teeth to it, it still doesn't work. And that's the key. So as long as it's soft money, let's go.
Other questions? They're shutting us off, folks. What's up with that? Thank you very much, everybody. Panel, thank you.
All right, great job, everybody. That concludes our program. We'll be back here next month on October 19th, and the topic will be supply chain. So thanks for being here, everybody.
I could have went. Could have managed.